So I'd like to welcome everyone to Riveron's Ask the Experts webinar, where we'll discuss how to manage a successful transaction close. We'll share some of our perspectives on things companies can do to increase their chances of realizing the planned value of a transaction. As part of this, we'll cover key considerations across financial, tax, and commercial functions. So the first thing I'd like to do is introduce today's presenters. First, I'm Jonathan Ford. I lead Riveron's Southeast region, as well as our National Performance Improvement Practice, and I'll be moderating today's discussion. Mike Dunkel is a director out of our DC office who works in our transaction services practice. Gary Bedsole is a managing director in our tax practice based out of Birmingham. And then Damon Cade is joining us from Houston, is a managing director in the performance improvement practice. We're also very pleased to be joined by the CFO of LearnZillion, Matt Kennard, who will share some of his personal experiences navigating transactions as a CFO. Before we go into the content of the discussion, I'd like to cover a few key reminders. First, Riveron's past webcasts are available on our website, and we'll continue to conduct regular webinars on a variety of practical topics. Please keep in mind that 4 polling questions must be answered to obtain CPE credit. If you have questions, feel free to ask using the Q&A option in Zoom. Webinar evaluation forms and CPE certificate will be emailed to you following today's presentation. Just to note, the on-demand video is not eligible for CPE credit. Finally, you'll receive a follow-up email after the presentation, including access to this webinar recording and the presentation deck, the option to join our webinar's mailing list to receive future invites, and contact information for our presenters. And with that, I'd like to move to our first polling question. What is the likelihood you will be involved in an acquisition or other type of transaction in the next 6 months? Do you think it's A, very likely, B, likely, C, possible, or D, unlikely? While you're answering, I'll ask our first presenter, Mike Dunkel, what are you seeing in the deals market as we navigate the pandemic, particularly looking at the last couple of months?
Thanks, Jonathan. We've all obviously heard a lot about activity halting due to COVID, but we also saw a lot of companies go to market and really leverage their growth from COVID. This would include the healthcare space, food delivery, home renovation related businesses, etc. And lately we've been seeing a lot of financial and tax diligence, which is indicative that buyers will be closing deals in the near term. One other thing to kind of keep in mind is that 2 factors on investors' minds is how much dry powder is out there that needs to go to work, and also the concern that favorable tax laws to investors could potentially change based on the election outcome.
Okay, great. And so with that, it looks like a little over half are either very likely or likely among the participants, which speaks to Mike's view that things are picking up and there's a decent amount of dry powder that companies are going to try to put to work over the next few months. Moving forward now, I'd like to cover an introduction and an overview of the topics for today's discussion. So we'll cover how companies can use specialists to improve their chances of managing a successful transaction close. We'll also cover the risks inherent in transaction agreements. We'll talk about ways companies can leverage different types of expertise to mitigate a variety of risks. And our focus today will be across common financial, commercial, and tax considerations companies will typically need to address. And so with that, I'll now turn it over to Mike Dunkel, who will cover an overview of different types of agreements and then move into the financial considerations for transactions.
Thanks, Jonathan. Looking forward to it. So we're going to talk a lot about SPAs, also known as PSAs or MIPAs, or just simply purchase agreements today, as well as TSAs. SPAs are legal contracts that formalize an obligation for a buyer to purchase from a seller with specific terms and pricing. They're very long, complex, lots of details. Typically, they're passed back and forth between buyer and seller's attorneys quite a few times, and this is often where we are getting involved, working hand in hand with them. TSAs, transition service agreements, they are also legally enforceable contracts, And they specifically control how a seller will support or pay to support a business post-close. And this happens during an agreed to separation period. Both of these main transaction agreements are being used increasingly by buyers and sellers as strategic tools. Moving on to the purpose of SPAs. As non-legal specialists, we specifically focus on items impacting the final purchase price, also known as closing consideration, and the allocation of risks and how those are managed. To properly identify these risks and areas of opportunity, we basically need detailed work plans that happen well before close and in phases that are somewhat strategic as far as how communications work and what ends up getting shared with the other side. There's also a fair amount that transaction specialists do after the transaction closes to calculate or police, if you will, how funds actually flow at close and then are trued up. Separate from that, and really related to TSAs, operating plans and separation agreements are commenced post-close, and they often require contract and functional support specialists. Lastly, I'll say that we do play a key role often in raising or defending against disputes on the outcome of how the close process happens, since there's a lot that comes to light after the dust settles from a transaction close. And moving on here to really talk about our work a little bit as specialist advisors, it's really not diligence. Even though it's very related to financial, tax, and operational diligence, what we're really talking about here is how we as financial, tax, and commercial specialists strategically use contract terms and language to manage or sometimes even exploit certain risks. So now to talk specifically about financial aspects, the first of 3 sections in this presentation. As it relates to the financial side of the house, we add value most commonly through identification of indebtedness, calculation of working capital targets, drafting definitions and accounting principles, and constructing adjustment mechanisms that impact the purchase price in a way that benefits our clients. These are all negotiated items. They're not black and white. There's no rules. Our goals are specifically to identify and quantify items that protect or benefit our clients pre-transaction close. And what we want is for both sides to walk away feeling the transaction closed fairly and accurately. So now to talk a little bit about the transaction timeline as an illustration here. Referring to this timeline, purchase agreements often have a lot of detail around the closing process with regards to deadlines, when certain items need closed out and communicated, access to information and who gets that access, and how a dispute would be handled if it comes to that. The key things to take away when it comes to thinking about the process is that tighter definitions and processes increase certainty and they minimize disputes. Loose definitions do the opposite. Less sophisticated buyers or sellers may fall into this trap and be unaware of the uncertainty they create. And sometimes more aggressive parties, as opposed to less sophisticated parties, will use these as opportunities to exploit the other side. Moving on to arriving at the purchase price. So what we have here is an overly simplified enterprise value to purchase price equation. It's highlighting the fact that the valuation of the company is not the same as the purchase price. How much net cash, debt, items agreed to be treated as debt, and the working capital true-up all impact the purchase price. And just for basics, if helpful, the net working capital true-up is also referred to at times as the closing mechanism. It's simply how much actual working capital exists as of the date of close when the business changes hands as compared to the agreed upon level of working capital, in other words, the target. So let's talk about setting this target a little bit. In most simplistic terms, working capital as it applies to deals is cash-free, debt-free, and it also excludes income tax and non-operating items. If a company's accounting records are accurate, it should represent the level of near-term cash conversion, or in other words, how much cash is tied up in current assets and current liabilities that relate to operations. Us type A accountants get a little excited about this stuff. This is the only place that we can get out of our box and get a little creative. Setting a working capital target is not an art. I'm sorry, it's not a science. It's definitely an art. And it's where the majority of our strategy is. One thing to keep in mind is that buyers and sellers who wait to bring their advisors in until after working capital expectations have been set with the other side, they really limit what their advisors can do for them. When we're analyzing working capital, which is what this chart depicts, what we're doing is normalizing monthly levels and then looking at averages over a variety of periods to understand what should be expected at the closing date and would represent the future. Using a 12-month average is most common for setting a target.
And so, Mike, just to interrupt for a second, how do you think about setting a working capital target when you're looking at a company that has a track record of delivering high growth, top line?
That's a good question. So buyers will want to use a shorter average period, call it 3 or 6 months, for a period that is going through high growth. Sellers will want the opposite. The reason why is that a seller is going to want to reach back in time when the business was smaller and thereby decrease the working capital target with the understanding that they would then over deliver more than the target at closing, and then they would get paid for that by the buyer. Next, let's talk a little bit about areas of common negotiated indebtedness. So indebtedness, or also referred to as debt-like items, they reduce the purchase price dollar for dollar, and they're 100% paid for by the seller. The items that you see here are highly contested. These are not treated the same from one deal to another. Overall, a buyer wants to treat as many things as debt-like as possible, and that's what they're hiring their advisors to do, to uncover these things and give a case as to why it should be debt-like. A seller wants to keep as much of this out of indebtedness and, if necessary, in working capital. The reason why is if it's included in working capital instead of indebtedness, the seller only has to deliver a normalized level. They do not have to pay for 100% of the liability. So let's talk about some common working capital areas of disagreement, also highly negotiated subjects. First off, as it relates to indebtedness, one very simple and common mistake that is made is that if an item is included as indebtedness and it was not removed from working capital, it cannot be in both. If a liability is in both, it's double counting, and it will definitely lead to a dispute if the amount is significant. We've been involved in plenty of deals where you would have this overlap because of a complexity. One would be, for instance, where management bonuses might be negotiated as being indebtedness, but they weren't removed from working capital because management bonuses are just a small part of an entire accrual account that includes payroll, normal employee bonuses, etc. The other item that really is negotiated commonly between buyers and sellers is GAAP compliance. It's a huge sticking point, and we can talk about this a little bit more on the following slide here, where it's really, so GAAP refers to generally accepted accounting principles, and it's required for audited financial statements. US GAAP in the US is how it's referred to, and it also applies to regulatory driven reporting. It does not apply to working capital for deals. It can, but it does not have to. Working capital for deals is not regulated, and all terms are 100% negotiable. So with that said, the purpose of a closing mechanism or the net working capital true-up we talked about before is really to provide fairness at close. And sometimes this requires not following GAAP. Overall, GAAP compliance is favored by buyers, and it's very, it's a point that basically gives them, as a buyer, more options at close to interpret working capital, interpret indebtedness, interpret net cash and other items that result in cash flow. And sellers are going to push against this, and they are going to favor historical accounting practices. So let's talk a little bit now about the purchase agreement, and specifically the fact that it governs everything. It doesn't matter what was agreed to or communicated in an email, separate schedules and an offer letter, or even working capital targets between buyer and seller. The words and supporting schedules in the purchase agreement is what dictates how closing will occur and what an arbitrator would consider as the highest mandate if a dispute was formally raised.
So Mike, what would you say are the main arguments a buyer can make to treat an item as indebtedness?
To treat as indebtedness means the seller is going to pay 100% of that item. So to kind of, as a buyer, ask for that from the seller, the essential arguments are going to be that the obligation is truly a cash outflow and someone actually has to pay cash for that item or situation. And secondly, that it relates to pre-close activity. And separate from proving that it relates to pre-close activity that would have benefited the seller, the last argument could be that it just is unrelated to operations completely. It's really important to have an advisor or an internal team member who is experienced with the industry of your proposed deal for more reasons than just valuation and commercial aspects. Cash conversion performance and the accounts used for certain aspects of a business are very industry specific. For example, in software and tech deals, they often have high seasonality in cash collections, and they have a need for negotiating how much cash should be left behind by the seller, as opposed to relying on accounts receivable levels to fund operations immediately following the close date, whereby the buyer needs cash to run the business. With that said, I'm going to hand the mic to Matt Kennard, CFO of LearnZillion, who actually went through an impactful deferred revenue negotiation through the sales process of a software as a service company.
Morning, everyone. Nice to meet you virtually. My name is Matt Kennard. I'm the CFO of LearnZillion, and had the good fortune of both working with Riveron prior to the acquisition and then as an advisor during our acquisition. Mike referred to a number of the games that folks will try to play around your working capital and deferred adjustments, as well as the definition of indebtedness. And we were in a situation where we had scaled up substantially, nearly tripled in size over a 12-month period prior to the acquisition. As a result, it was really important that we were able to get a favorable definition of indebtedness, that working capital targets were set with a collar to ensure that we had some room come finalization of the books for the sale, to have some fluctuation within working capital without paying a substantial penalty, and that our deferred revenue was favorably negotiated. It was really an advantage to us as we worked through the process to have Riveron on our side working through that. And in fact, Mike Dunkel was our lead advisor for that work. So happy to turn it back over to you, Mike, to talk in a little more detail.
And actually, Matt, we'll move on now to our polling question too, but thank you for that. So on the second polling question, what are the reasons that you have observed as increasing transaction disputes? A, high deal valuations or working capital negotiation used as a method to extract transaction value. B, generic agreement terms used and or misunderstanding between the parties. C, other reasons. Or D, you haven't observed recent transaction disputes. And Gary, while folks are answering this question, why don't you go ahead and share some of the things you're seeing regarding tax considerations companies are dealing with during the pandemic?
Sure, thanks, Jonathan. So the impact to the tax practice at Riveron was similar to the impact Mike described to the financial deal side. When the pandemic hit, our work slowed down slightly. We continued working on deals that were far along in the process. Buyers wanted to finish those deals, and then things slowed down a little bit more. Started to come back, and then the second wave, quote unquote, hit, and I think things really slowed down from the tax practice at Riveron. That was near the beginning of July. After that, things really picked up, say at the beginning of August. We've been on fire since then. Deals are really popping, buyers are buying. So I think things are really coming back. If not, they're all the way back, Jonathan.
Okay, great, thanks. So, interestingly, 60% of you, it looks like the A and B were the most common reasons that you've seen. And so now moving on, Gary, I'll turn it back over to you to talk about some of the tax-related provisions in purchase agreements.
Yeah, the exciting world of tax. Thanks, Jonathan. So the tax provisions in SPAs and acquisition agreements serve various functions. Those functions could include protecting the buyer from unknown tax liabilities of the target by using mechanisms such as indemnities or escrows, and we'll cover those in a few minutes. The acquisition agreement should also contain provisions to address which party has the responsibility for filing tax returns post-closing. This can include returns that relate to pure pre-closing periods but are filed after the closing date, as well as what we refer to as straddle period returns. Those are tax returns that cover a period that includes the closing date but doesn't end on the closing date. And we'll address how buyers and sellers typically divide up the taxes for straddle periods in a few minutes as well. Through the SPA, the buyer will want to obtain the maximum amount of information from the seller regarding the target's tax history, as well as the buyer wants a broad right to indemnification from the seller if something goes wrong or something isn't correct. The seller, on the other hand, will want to minimize risk that the buyer will have a right to indemnification, and the seller generally wants to provide the minimum amount of information as possible to have the transaction closed. So moving on to working capital, as Mike touched on earlier in the presentation, in almost all private target M&A transactions, there's a purchase price adjustment referred to as an adjustment for net working capital. This adjustment is intended to reflect a change in the financial condition of the acquired company between the estimate when the price was set by the buyer and the true financial condition of the target when the transaction closes. Net working capital, or generally current assets minus current liabilities, is intended to represent those assets and liabilities that are expected to have a short-term impact on the cash of the company. Current assets are generally those assets that are expected to generate cash within 12 months, whereas current liabilities are those liabilities that are expected to use cash within the same time frame. So sometimes on the balance sheet of companies, there's items referred to as deferred tax assets or deferred tax liabilities. You often hear the acronym DTAs or DTLs. Many people think that DTAs and DTLs refer to expected tax refunds or taxes due, but they're not actual taxes. They're just an accounting concept. They refer to timing differences, or they're accounting terms used to describe a situation in which certain revenue and expenses are recognized differently for tax and book purposes, and they're generally non-cash in nature. Even though they may be classified as short-term on the balance sheet, the classification as short-term is derived from the classification of the underlying asset or liability that has the timing difference for book tax purposes. It doesn't necessarily flow that the DTA or DTL will have any impact on cash within 12 months or even ever. Therefore, DTAs and DTLs are typically not included in working capital calculations. Well, what about non-income taxes like sales and use taxes or property taxes? Those items are more operational in nature, and they're typically included as are short-term receivables and right to refunds. So moving on to purchase price allocations. A transaction may be legally structured as either the acquisition of the assets of a business, and there'll be a lot of assets in the business. Typically, you might have a little bit of PP&E, you'll have some intangibles, maybe there's some cash or receivables or inventory, etc. Or perhaps the buyer is purchasing the equity of several different legal entities. The allocation of the total purchase price among the assets or equity, if equity is being acquired, is important from a tax standpoint to both the buyer and the seller. The parties should consider and include in the SPA who is responsible for preparing that purchase price allocation or the initial draft of it until the parties agree. How long after closing is that first draft due? And there also should be a mechanism if there's a dispute among the parties. How is that dispute resolved? The buyer and the seller may have diverging desires as to how the allocation is made. And I'll give an example. A buyer may, for example, want more of the purchase price allocated to fixed assets that are eligible for immediate bonus depreciation expensing, meaning the tax code permits that amounts allocated to PP&E, most PP&E, there are some exceptions, can be immediately expensed by the buyer for income tax purposes. Very beneficial to the buyer to write those off immediately. The seller, on the other hand, may be adverse to that allocation. Allocation of amounts to PP&E may give rise, depending on the type of seller, to what's referred to as depreciation recapture. And depreciation recapture may be subject to higher tax rates than, say, capital gains, which are 20%. Depreciation recapture may be subject to tax as high as 37% from a federal rate. I've included an example on the bottom of the slide of some general language that's often included in a purchase price allocation. It refers to a schedule, and the parties will agree to the methodology, which is generally what we refer to as the residual method of allocation under Section 1060. It's often very similar, if not the same as book. Okay, moving on to escrow agreements. Escrows are employed in a large number of private company acquisitions. Escrows are largely used to protect the buyer from the risks associated with the acquisition, especially when the buyer has concerns about the seller's credit risk. The buyer sets aside a portion of the total purchase price, which is deposited into the escrow for a negotiated period of time after the close. The buyer will receive the funds back from the escrow if certain defined conditions either occur or don't occur. From a tax standpoint, the parties need to think about who will be treated as the owner of the funds deposited in escrow until disbursement. Typically, the buyer is treated as the owner, but it really can vary. As funds are released from the escrow to the seller, the treatment is generally additional purchase price, and that will flow through the purchase price allocation methodology. If you're using the residual method, often that allocation is to some type of intangible, goodwill, or some other type of intangible. There also can be an interest component to the release of funds, depending on whether or not the funds, how long they were deposited, or whether or not, the amount in the funds. There's exceptions for low dollar deposits in escrow. So I'll give a real world example of a escrow that Mike and I actually worked on the same project. So I was asked by a buyer to conduct tax due diligence on a private company and identified a very significant issue. It was a partnership. The partnership had taken the position that while its legal owners were foreign partners, they were foreign legal entities, that the partnership had taken the position that its true owners from a tax standpoint were U.S. partners. If there were foreign partners, there would be a requirement for the partnership to withhold and remit funds to the IRS. U.S. partners, everything's flowing through and being taxed in the U.S. I thought it was a very aggressive position. It was probably unsubstantiated from the facts. So I told our client there's a real risk here, calculated the number of the potential exposure, for the years the statute was open, and it was a real big number. It was, say, 10% of the purchase price. We worked with the buyer, the buyer's counsel, the seller's counsel, to set up an escrow for this amount, and the buyer deposited in the escrow. And as the statute of limitations for the earlier years expired, the funds were remitted to the seller. So I thought that was real interesting. So moving on to tax representations, which represents a large part of the SPA. Reps and warranties are generally promises made by the seller regarding the past and current state of the business that's being acquired. Reps and warranties assure the buyer that the seller has operated the business as represented. At a high level, a buyer-friendly agreement will want to include broad and discretionary language to cover as many issues as possible. But on the other hand, the seller-friendly agreement will want to narrowly tailor the language to specify the exact terms being promised. This goes to important risk-shifting role that reps and warranties play in a deal. The buyer expects the seller to retain the risk of loss that could result from false statements the seller's made. Broad language provides comfort and certainty for the buyer to price the deal and plan for future operations. So on the next two slides, I've given some examples of common tax reps that are found in acquisition agreements. The language in brackets are language that often sellers like to insert that narrow the scope of the rep. So I'll just address a couple of them. The first one here, target has timely filed all tax returns. A seller would want to minimize, let's say, returns that are non-income tax in nature by inserting the language and all other material tax returns. So if it's non-income tax, it's not material, that rep doesn't apply to that tax return. Another one worth mentioning is that the second one, tax returns are complete and accurate in all material respects. The seller obviously would want to limit the scope to material respects. Buyer wants them straight up. They're either true or false. They're accurate or not accurate. And the third one there, all taxes due and owing by the target, whether or not shown on any tax return, have been paid. The buyer would insert that language in the parenthetical. You haven't paid things that are not shown on the return, the rep's breached. On the next slide, we'll cover a few more examples. The first example confirms that all the tax returns provided during due diligence were accurate and complete. And the second to the last example, I find this one interesting. It's in a lot of agreements. It's the seller is stating that the target has not been a member of any consolidated group. And the reason you see that is there's something called successor liability or liability under the consolidated return regs. If the target has been a member of the consolidated group, the target can be responsible for the taxes of the other members of the consolidated group. So moving on to tax indemnities, which often key off of the reps. A buyer's right to indemnification is a right to reimbursement in respect of a particular liability or loss suffered. The purpose of an indemnity is to move the risk of a specific matter from the buyer to the seller and to provide the buyer with reimbursement with respect to a specific loss. Public deals often don't include a right to indemnification, and there's usually no survival of the reps. It's generally buy as is. Other deals may include an indemnity, but with varying lengths of time that the representation survive closing. Some of them survive. Often a pro-buyer survival will be that the rep survive until the end of or expiration of the statute of limitations for tax purposes, plus some amount of days, 60 days, 90 days. Those are pro-buyer rep survival. There's usually a general indemnity in the agreement that provides overall protection for breaches of representations as a whole. There'll be a lot of other reps in the agreement. Taxes may be included in the general indemnity, or they may be included in a separate tax indemnity. A word of caution, if you include taxes in the general indemnity, they're often subject to various limitations, such as deductibles, ceilings, caps on the right to reimbursement. A separate tax indemnity may not have that. So when I drafted and my previous employer drafted the agreements, I always preferred to draft a separate tax indemnity to pull myself out of the general indemnity limitations. Including taxes and the general indemnity may limit the buyer's right to recover losses. So on the next slide, I've included, if you have a separate tax indemnity in the agreement, I've listed here what some of the rights to indemnification are. The first one, very important, any taxes of the target with respect to pre-closing tax periods. If the seller hasn't paid taxes for a pre-closing tax period, this gives the buyer a right to collect or be indemnified from the seller for those taxes. You don't even have to rely on a breach of representation. I've included a right to indemnity for a breach of representation in the third bullet there as well. Okay, final topic for taxes, tax covenants. And these are promises by the parties to do something in the future, and we'll cover an example here. So let's say we have a transaction that closed on June 30th. The seller is obviously filing tax returns before that date for the company of the target. There might be, and there typically are, tax returns that are due after June 30th, but relate entirely to the pre-closing period, as well as what I refer to as straddle period returns. And those are returns that encompass the June 30th closing date, but do not end on it. And a good example of that would be property taxes. They're often for the calendar year, the entire calendar year. It doesn't cut off when the closing occurs. The city, county, or state doesn't care that the closing occurred of the real estate. The taxes are due for the full amount of the year. So covenants define who's responsible for filing those tax returns, and they'll often include an allocation methodology. And for most instances, generally speaking, if a seller is responsible for pre-closing taxes, then the seller's going to want to file any pre-closing tax returns, even if they're filed post-closing. For straddle returns, it varies. The buyer could take responsibility for that, or the seller. It just varies how the parties agree who's responsible for preparing it. The buyer will want to have a right to review if the seller's preparing it. And on the next slide, I've given an example of how the parties often allocate straddle period taxes. Those are taxes for the full year. I mentioned real property is a good example. Taxes for the full year that don't cut off because of the closing date. So there's generally two types of allocation. If it's an allocation, if it's a type of tax like property tax that lasts for the entire year, they'll just simply allocate it based on the number of days pre-close and the number of days post-close, with the buyer paying post-close, seller paying pre-close. All other taxes, such as some types of income taxes, may not end on the closing date. The parties will allocate based on the closing of the books type method. Okay, and with that, I think we've got our next polling question.
Thanks, Gary. So on the next polling question, the question is, were taxes a significant consideration or issue in any M&A transaction that you undertook in the last 24 months? The answer choices are A, yes, B, no, or C, not applicable because there were no M&A transactions. And while people are answering the question, Gary, why don't you give us an example of a special consideration for SPAs that arose from the recent CARES Act?
Yeah, so the CARES Act was passed at the first part of this year, and there were a lot of provisions in it that potential buyers and sellers need to take into consideration. One of them is payroll taxes and payroll taxes deferral. So the CARES Act permits employers to defer the payment and deposit of certain types of payroll taxes. Buyer needs to be aware of that. Has the company taken advantage of that? There's a large or potentially large amount of payroll taxes out there that haven't been paid or funded. And so the buyer's going to want to know about that, and the parties need to have an understanding of how that's handled through the purchase agreement.
Okay, great. Thank you. And so now the next topic we'll cover are commercial pre-close considerations. And so we'll have Damon Cade take over here.
Hello all, Damon Cade here. 4 areas we're going to cover that could be impacted through an SPA or through a TSA. Our commercial, management, back office / IT support or supply. Really, all four of these would apply in situations of carve-outs where TSAs potentially could be involved. Number two, number three, the management and back office support. Those could be involved quite heavily when you're buying a holistic business, where you're trying to retain management or key employees when you buy that business, leveraging potentially their back office for an extended period of time till you potentially tuck in that business. Diving in a little bit deeper on the commercial side of things, looking at areas of contracts for customer pricing, volume, and sales and marketing. These are three areas that could be of risk when buying either a company from a carve-out, mostly in carve-out situations, where you're looking to see if contracts can be reassigned. If you need to reassign those and they're not reassignable, they need to be renegotiated prior to closing. Looking at exclusivity agreements, potentially with the parent company in a carve-out situation. Looking at customer risk profiles, are there credit risks that need to be addressed, and maybe a credit analysis needs to be done by the seller prior to closing. So those are some of the areas from a customer contract point of view. Pricing could obviously be impacted as well, where volumes could change or rebates are not in place with the new co, where the remain co had volume agreements with some product lines that did not come across the transaction, so you have a reduced product portfolio. Obviously, you could have different services if you're not selling products where rebates can't be taken advantage of. And then really a key point here on the sales and marketing side is retention of those sales team or business development members through either non-compete agreements that may be already in place and you want to assign them to the buyer, or you can look at adding a non-compete agreement with the seller so they can't go back to the seller for a given period of time. The last piece is marketing, branding, where you have a period of time where you're leveraging the brand of the seller and have some sort of transition period. The next area we'll go to here is the management continuity section. So there's really two pieces focused in this area. It's management team. This isn't just executives, but this is people in the back office. This could be front office, really determining those individuals that you want to retain if it's a complete purchase or if it's a carve out. I mean, negotiating with the buyer, certain individuals that need to come along with the business, putting some sort of succession planning in place. Maybe you're offering them promotions, maybe additional responsibilities, additional financial rewards. That could be in the form of retention bonuses, equity, longer term incentive plans. So those are really key, not only for the executive team, but for key members that are below that, depending on the type of transaction, to keep that business continuity going and being consistent with that customer supply and employee base. The last piece there is if there is a carve out involved, to set up some sort of separation office on the seller side to help them help the buyer transition processes, data, services or products. Maybe it's facilities, inventory, so on and so forth, for a given period of time. That could come through a TSA, where that separation management office is managing aspects of that TSA, or that could just be a requirement through the SPA, where that office needs to support the data and the movement of product or services for the new entity to be stood up properly. So the next slide we're going to talk about is some other components within the back office and IT support area that you just need to generally think about. This could be focused on finance data, cutting over banks. Maybe you're taking over bank accounts. Maybe you have situations where you have a new legal entity where these bank accounts need to be closed. Lock boxes, signature forms. These are typical items that need to be addressed in writing, typically in an exhibit through the SPA. You have some transition periods as well, from an accounting point of view, or maybe from a front office point of view, where You have open customer invoices, you have open vendor invoices. Maybe they're going to be remitting back to the old co in the case of a carve out, where you need to be able to plan for how you're going to handle that cash movement. Obviously, that goes into potentially a working capital trip as well. But you also need to have solid communications to your customers or vendors when the transaction's going to occur, how to transact after post-closing. Those types of items need to be addressed within these agreements. People is obviously key to any business, and moving timekeeping, payroll data, employee records, transition of benefits. Often these are things that you try to accomplish around close, but often there is some sort of period where you just can't do it all during the close, prior to the close period, where they need to be completed post-close. And maybe that's through some sort of a side letter agreement within the SPA, not always through a TSA component. Maybe you're buying the business holistically and you want to transition these into the buyer's benefits plan or payroll plan. So you need to keep these systems and solutions around for a period of time. Legal, you have a lot of documents of all their NDAs, policies, procedures. You have IP. You have potentially new changes of legal entity names they're going to exist, but maybe you're changing legal entity name post close. And then information technology is probably the biggest, where it touches all these areas, where you could be, obviously you get a new transactional data, enterprise data over to the new systems of the buyer. But there's a lot of back office or a lot of infrastructure transition, probably less now today with the cloud environment, but in the past, a lot of server migration, email migration, help desk, re-imaging PCs, a lot of IT infrastructure is all using one sort of version of Windows on the PC if they are using PCs, but taking into account disaster recovery. So these are all items you typically want to account for within your agreements, be it a TSA or SPA. So the next section we're going to talk about is supply here. This is probably most critical when you're standing up a new business and you're trying to establish credit. Oftentimes there is no credit for the new business, and that needs to be reestablished. You need to renegotiate supply contracts. If you're a manufacturer, you need to look at renegotiating contracts prior to closing or pricing. Maybe your volume, your buying power is decreasing, so the pricing is not as advantageous because you're not buying as much. There's situations where you can leverage the seller to buy on behalf of the buyer for a period of time until credit's established. There's situations where the seller in carve-out situations need to provide facilities. They need to move inventory around. So all that needs to be accounted for within the agreements. Obviously, inventory, be it raw materials or finished goods, needs to be accounted for through some sort of schedule or exhibit within the SPA. Physicals need to be conducted, and oftentimes in situations, those items are commingled and they need to be separated prior to close, and oftentimes that just doesn't happen because of logistics. So the next area we're going to talk about here is the TSA. These are obviously in every transaction you don't have a TSA, but these are situations where you're buying an entity or assets or set of assets from a company and carving it out. Lots of different functional areas to talk about here. I think back office, finance and accounting, and IT are the ones that I see most often negotiated. Oftentimes, or all the time, you need to determine what that cost structure is as a seller, what that period of time that TSA is going to be in place for. So that's really up to the buyer to determine that, and the seller has to determine if they can support it for that length of time. Those costs need to be determined. That's pretty heavy lift. Obviously, prior to executing the SPA and the TSA, And typically situations that I've seen, they're cost plus because there is some sort of severance that happens with some employees at the end of the day. Other times are just cost, whatever the total cost for an FT or a process or overhead is, that's just passed along to the seller. So really, it's really key for TSAs to determine the functions, the specific people, the expectations, the service levels to be successful. I've seen some that are really complex and hundreds of pages, and I've seen some TSAs that are, from a business point of view, quite short, and oftentimes there's some risk with those not defining service levels, functions, expectations that the buyer needs to define quite heavily. So the next slide here are some additional considerations for a TSA. I think this is one area that you want to start the process early. If you're buying a entity from a larger organization, because oftentimes these get overlooked until the very end in terms of who's part of the TSA, what business functions. Maybe the buyer doesn't need the executive staff anymore. Maybe the buyer doesn't need sales and marketing support anymore. So these need to be negotiated up front, but there's also a lot of data that you want to make sure that you're getting through the TSA process. Maybe historical or current sales analytics. You need to determine kind of assistance throughout throughout the post-close process with customers and vendors. Maybe you're not cutting over contracts prior to close, but you need 30, 60, 90 days, a quarter or two to transition those over. Obviously, assembling an organization that's going to be very effective to manage the TSA. That's oftentimes I see where you're just getting kind of bits and pieces. You're not getting a complete organization running the TSA, so that's very important. So the buyer can be successful. We talked about commercial and supply, determining lines of credit, credit with vendors if it's a new co or new organization. Service levels and pricing. These are all items that are very important in the TSA, like I talked about earlier. And then really the last point, from my point of view, is getting high quality support personnel from the buyer to support the business. Without that, it's I've seen these TSAs just really get nasty from a buyer seller point of view. Just because the seller hasn't put in their best foot forward in terms of team and attention to the TSA process. So that brings us to our last polling question, Jonathan.
Thanks, Damon. So on the fourth polling question, at what point within a typical transaction process would you engage experts to support various agreements? A, after the LOI is executed. B, upon initial draft of the agreements. C, as part of the finalization of closing consideration. Or D, post-closing to manage agreement compliance. And so Damon, while people are answering this one, can you talk us through a situation you've seen where the TSA was negotiated too late in the process and what the implications of that were?
Yeah, the situation that rings a bell for me, we actually did a lot of TSA planning, but it wasn't really focused until the very end of the deal, I would say within 5 days of closing. And really the area that fell through the traps was executive management compensation from the seller's point of view, where the buyer just didn't want to pay for that and they didn't want to pay for that support. So that became kind of contentious at the end, and it really was oversight on the buyer's part, really digging into the details of what they needed prior to closing, or without looking enough or not spending enough time on the actual costs and support they needed.
Okay, got it. So, I mean, with that, I think we can move into Q&A, and we've had several submitted that we can start with, and please continue to submit your questions. So the first one, Mike Dunkel, it would be for you, and that is, what is a working capital collar, and how is it beneficial to a buyer or seller?
Thanks, Jonathan. It's a good question. We see a lot of confusion with collars. A collar is basically an agreement for a range that working capital at close can be above or below the target, and there's no adjustment. When two parties agree to a collar, it's a good thing. Us as advisors really look at that as a win. It indicates that neither the buyer or the seller knows if working capital is going to be above or below the target. So in other words, no one's really trying to game the system, and the target's set fairly. Another thing that the collar really helps with is when management is transitioning from working for the seller to then working for the buyer post-close. Collars are often intended to alleviate pressure on an accounting team who has switched employers like this. And it's also helpful if, for instance, there's an executive who had equity interests in the company pre-close, and therefore that person, for instance, a CFO, that is involved in the finalization of working capital, they may actually benefit or be adversely impacted by the working capital true-up. So if you have a range that doesn't really impact them, it helps them be a little bit more impartial.
Got it. Thank you. Gary, a tax question for you. What tax considerations should be made for employee tax deferrals at transaction close?
Yeah, so the CARES Act, I'll give a little bit detail on what the CARES Act did for payroll taxes and then how it should be addressed in the acquisition agreement. So the CARES Act allows for the deferral of the employer portion of Social Security payroll taxes for the period from March 27 through December 31st of 2020. And there are rules on when that amount should be paid following December 31st, 2020. Typically, the standard definition of pre-closing taxes in the acquisition agreement covers those deferred taxes such that the seller is generally responsible, but buyers, they want to specifically state that in the agreement to make sure it covers those deferred taxes. The buyer also needs to ensure that the that targets benefiting from the deferral have sufficient reserves to cover these future liabilities, or that the liabilities are reflected in the calculation of the target's working capital or indebtedness. If the economic impact of those taxes is not borne by the sellers at closing, then the buyer may be limited on seeking reimbursement from the seller. So it needs to be addressed in the acquisition agreement through some mechanism.
Got it. Thank you. And the one last question before we move to our closing content. So Damon, how often do you see companies having to renegotiate significant vendor contracts? And what's your recommended best practice on timing for that negotiation?
Yeah, that's a tricky one because sometimes you obviously don't want to let the cat out of the bag about the transaction, but often some vendors, you could put them under an NDA and start negotiating with them a little bit ahead of time, prior to the transaction closing. So really, it's locking down key supply. That's critical. But oftentimes, some of the suppliers that I've seen just get a little bit of credit wariness, if you will, worried about the new business, why it's being carved out or bought in some cases. So I see it quite a bit where you just got to bring the vendors in under the tent, if you will, and get them under an NDA and start that process with about a 30-day window of the expected close timeline.
Great, thank you, Damon. So with that, we'll move to close. Before we do that, I'd just like to say I appreciate all of your time today. Thank you for joining our webinar. Also, thank you to my colleagues for your contributions to the discussion, and thank you to Matt Kennard for joining as well. As I said earlier, each of you will receive a follow-up email that will include access to this webinar recording and the presentation deck. It will include the option to join our webinar's mailing list to receive future invites and contact information for our presenters. Along with today's presentation, other relevant content is available on our website, and so please visit and peruse that. If we weren't able to get to one of your questions, we'll follow up with you directly following the webinar today. And finally, please continue to join us for future webinars that will be coming out over the coming months. Again, thank you very much for joining us. And with that, we will close the call.